People think the Great Depression was just bad luck. It wasn't. It was the result of a system pushed too far for too long. And the same pattern still exists today. Let's go back to the 1920s. The United States was experiencing rapid economic growth. Industrial production was rising. New technologies were spreading. People were optimistic about the future. But underneath that growth, something unstable was building. Stock prices were rising much faster than the real economy. Companies were not growing at the same speed as their valuations. But that didn't stop people, because the belief had already taken over. The belief that prices would continue to rise no matter what. And then came leverage. People started buying stocks with borrowed money. This is called buying on margin. You didn't need to have full capital. You only needed a small percentage, and the rest was borrowed. This created a dangerous situation, because as long as prices were rising, everything looked safe. But in reality, the entire system depended on one thing: prices must continue to go up. That's the illusion of every bubble. It feels stable until it isn't. By 1929, the market had become extremely fragile. Too much debt, too much speculation, too many people inside the market without understanding the risk. Then something small changed. Prices stopped rising. Not crashing yet, just slowing down. But in a leveraged system, that's enough. Because once prices stop rising, borrowed positions become dangerous. People start to panic. Margin calls begin. Investors are forced to sell. More selling leads to falling prices. Falling prices trigger more margin calls. And the system starts collapsing on itself. This is not random. This is mechanical. In October 1929, the market crashed, and the consequences spread quickly. Banks had invested heavily in the market. When the market collapsed, banks failed. People lost their savings. Businesses lost access to credit. Companies closed. Unemployment exploded. This is how a financial crash becomes an economic crisis. But here's what most people miss. The crash itself was not the main problem. The real problem was everything that was built before it. The excess, the leverage, the blind confidence. And this is why the same pattern repeats, because human behavior doesn't change. We saw it again in 2000 with technology stocks. We saw it again in 2008 with housing and credit expansion. Different assets, same structure. And if you look at markets today, you can still recognize the same signals. High valuations disconnected from fundamentals. Cheap and easy access to money. People entering markets without understanding risk. And the belief that this time is different. But it never is. The goal is not to predict the exact moment of a crash. No one can do that consistently. The real advantage comes from understanding the cycle. Understanding when the system is becoming unstable. Understanding when risk is no longer priced correctly. Because once you see that, you stop chasing the market. You stop reacting emotionally, and you start thinking independently. History doesn't repeat exactly, but it follows the same structure: overconfidence, expansion, excess, and then correction. And in markets, that pattern is everything.